In the hidden corridors of power, behind the headlines and market tickers, lies an institution few understand, yet all depend on, a force capable of shaping economies, altering fortunes, and sending shockwaves through global markets. This is the world of the central bank, the guardian of money itself. At first glance, a central bank looks like any other financial institution. But its role is singular, unique, and unrivaled, controlling the money supply and steering the economic destiny of nations. From London to Tokyo, Washington to Dubai, central banks hold the levers of monetary policy. They are the stewards of inflation, the arbiters of credit, the silent conductors of the global financial orchestra. Through their decisions, often unseen, sometimes controversial, they can unleash growth or stifle it. Their most powerful tool: interest rates, the price of money. When central banks raise rates, borrowing becomes more expensive, slowing spending and cooling an overheating economy. When they cut rates, loans become cheaper, encouraging investment, consumption, and sometimes bubbles. But these changes don't occur in isolation. They ripple outward, touching every corner of the economy, from mortgage rates in your neighborhood to exchange rates in distant emerging markets. Behind every rate decision is a balancing act. Tame inflation without choking growth, manage employment without stoking asset bubbles. It's precision policy at a planetary scale. So how do central banks actually move markets? They wield a toolkit both technical and psychological. First, they announce policy changes. Sometimes this alone shifts markets even before action is taken. This open-mouth operation can signal future intentions more powerfully than the policy itself. Then come the markets. Traders, investors, and institutions react in milliseconds, adjusting rates on everything from loans to bonds to currencies. These reactions feed back into the economy, a chain reaction triggered by a single decision. Central banks also use open market operations, buying or selling government securities to control liquidity, tightening or loosening the flow of money in the financial system. In times of crisis, they may push the boundaries further, printing money or expanding asset purchases, a tactic known as quantitative easing, to inject confidence and capital into a faltering economy. The influence extends far beyond national borders. When a major central bank like the Federal Reserve changes its rates, markets in Europe, Asia, and Africa react in sync. Currencies shift, capital flows accelerate, and investment strategies pivot on a dime. It's a power that binds nations together, yet also exposes vulnerabilities. A rate hike in one economy can strain debt-heavy nations half a world away. A surprise policy pivot can send shockwaves through emerging market currencies and global equity markets. For most people, central banks are invisible, a distant boardroom decision with abstract consequences. But the reality is undeniable. These institutions shape employment, influence prices, and ultimately touch the lives of billions. In a world increasingly defined by interconnected financial systems, understanding how money is controlled, not just where it flows, becomes not just academic, but essential. The question is no longer what central banks do, but what they will do next.